Welcome back, my people, and today we're going to see how Equity Bank went from a small building society to a banking giant. Imagine starting a financial institution when most ordinary Kenyans could barely dream of getting a mortgage or walking into a bank and being treated as an important customer. Now imagine that institution eventually becoming a financial group with about 22.4 million customer accounts, Kenya shillings 1.97 trillion in assets, and Kenya shillings 75.5 billion in profit after tax in 2025. That is the story of Equity. But here is the surprise part. Equity did not start as a commercial bank. It started in 1984 as a small building society targeting a market that many traditional financial institutions were struggling to serve: ordinary, lower-income Kenyans. So, how did a modest building society survive financial trouble, reinvent itself, embrace technology, and eventually become one of Africa's major banking groups? This is the story of how Equity went from humble beginnings to a banking giant. The story begins in October 1984 when Equity was established as Equity Building Society, commonly known as EBS. Its original business was mortgage financing. But there was a problem. Large section of Kenya's population were not being adequately served by the formal financial system. Equity's original idea was therefore relatively simple: provide financial services to people who were often overlooked by conventional institutions. The symbolism was even built into its early identity. Equity's original logo featured a modest house with a brown roof, representing the aspirations of customers who wanted to build secure lives, one step at a time. But starting a financial institution is the thing. Keeping it alive is another thing. And Equity was about to face its biggest test. By the early 1990s, Equity's original mortgage-focused model was under serious pressure. According to an Equity-published case study on its transformation, the building society experienced the asset-liability mismatch problems in its mortgage business. In simple terms, the institution's funding structure did not match long-term nature of the loans it was providing. The situation became so serious that in 1993, the Central Bank of Kenya declared Equity Building Society technically insolvent. Think about that for a moment. The institution that would eventually become one of Kenya's largest financial groups had reached a point where its survival was in question. For many companies, this would have been the end. For Equity, it became the beginning of transformation. The crucial change came in the 1990s. Instead of remaining heavily dependent on mortgage financing, Equity shifted its focus towards microfinance and broader financial inclusion. This was a major strategic decision. Rather than asking, how do we make our customers fit the traditional banking model, Equity increasingly asked, in quote, how do we build financial services around the realities of our customers? That meant reaching people and business that were often operating with relatively small amounts of money: small traders, farmers, micro business owners, ordinary households. People who might not walk into a traditional bank with millions of shillings, but who still needed somewhere safe to save and somewhere to borrow. This change transformed the economics of the business. According to Equity's own account of its turnaround, the period beginning in 1994 marked the first major phase of growth. The institution moved from the struggling mortgage model towards microfinance, and customer numbers and profitability began to grow. And that growth eventually created another opportunity. Equity could become a bank. In 2004, Equity Building Society made one of the most important moves into history. It converted into a fully fledged commercial bank. the name became Equity Bank Limited. This was more than a change of name. It meant Equity could operate with a much broader banking model and compete directly in Kenya's commercial banking industry. Then came another major milestone. In 2006, Equity was listed on the Nairobi Stock Exchange, now known as the Nairobi Securities Exchange. According to Equity's corporate history, the listing made it the largest bank by market capitalization at that time. And then in 2007 came a major injection of capital. International investment firm Helios invested $185 million in Equity. The investment gave the rapidly expanding bank additional financial muscle to scale. The small building society was no longer simply trying to survive, it was now trying to become a major financial institution. But money alone does not explain Equity's rise. One of the most important parts of the story was distribution strategy. Equity built its business around reaching customers at scale. Instead of concentrating only on wealthy customers and large corporations, it developed a mass market model. The logic was powerful. One customer with a small account may not generate enormous revenue, but millions of customers can create a very different business. Equity also invested heavily in technology and alternative channels. Banking gradually moved away from the traditional model where every transaction required a customer to physically enter a branch. This became particularly important as Kenya's financial system became increasingly digital. The result was a banking model capable of handling huge numbers of relatively small transactions, and Equity did not stop at Kenya. It began expanding beyond the country's borders. Uganda became one of its early international markets, followed by expansion into Rwanda, Tanzania, South Sudan, and Democratic Republic of Congo. The strategy was changing. Equity was no longer simply a Kenyan bank, it was becoming a regional financial group. The next major transformation came in 2014. Equity restructured its corporate structure, with Equity Bank becoming part of Equity Group Holdings and an operating holding company. This allowed the organization to manage a broader collection of financial and non-financial business under one group structure, and the regional strategy accelerated. The Democratic Republic of Congo became particularly important. Equity entered the DRC through acquisitions, including the acquisition of ProCredit's Bank Congo in 2015, later followed by another major acquisition in 2020. By 2026, Reuters reported that Equity had built a 24% market share in the DRC, making it the country's second largest lender. The lesson was clear. Equity was not simply opening branches for the sake of having branches. It was following customers, trade and economic opportunities across borders. So, how big has the journey become? The numbers tell the story. For the financial year that ended December 2025, Equity Group reported Kenya shillings 75.5 billion in profit after tax. That was a 55% increase from Kenya shillings 48.8 billion the previous year. Its total assets reached approximately Kenya shillings 1.97 trillion. Customer deposits stood at Kenya shillings 1.46 trillion. And the group reported 22.4 million customer accounts. Even more revealing is how customers now interact with the institution. Equity reported that more than 98% of customers' transactions were conducted outside branches, with 88.4% proceeded through digital channels. The institution that once depended on physical financial infrastructure have become heavily digital. And perhaps that is the most interesting part of the Equity story. It was not a straight line from success to success. There was no magical overnight breakthrough. There was a difficult beginning. There was a business model that failed. There was a technical insolvency. There was a complete strategic transformation. Then came banking. Then the stock market. Then international capital. then technology, then regional expansion, and eventually a Pan-African financial group. Equity's story, therefore, is not simply about a bank that became big. It's about an institution that changed its business model when the original model stopped working. And biggest lesson may be this: a business does not always survive because its first idea was perfect. Sometimes it survives because its leaders are willing to admit that the first idea is not working and build something better. That's how Equity moved from a modest building society serving ordinary Kenyans to one of Africa's most significant financial groups. And the journey is still continuing. Don't forget to like the video, subscribe to the channel. Thank you for watching and thank you for supporting us.